Let's dispense with the pleasantries. You are not a novice in your field. You are an expert, a professional, someone who has mastered a complex domain through discipline and intellectual rigor. The reason you're here is because you want to apply that same level of rigor to a new domain, the stewardship of your capital. The term investing for beginners feels almost condescending because the core challenge for professionals like you isn't a lack of intelligence, it's a surplus of it, which often leads to analysis paralysis. You're accustomed to solving intricate problems, to finding the optimal solution. Yet in the world of investing, the pursuit of perfection is a direct path to inaction. You're confronted with a lexicon of acronyms, conflicting expert opinions, and the ever-present visceral fear of loss. This isn't just an anecdotal fear, it's a well-documented cognitive bias known as loss aversion, first identified by psychologists Daniel Kahneman and Amos Tversky. Their work in prospect theory demonstrates that the psychological pain of losing a dollar is roughly twice as powerful as the pleasure of gaining one. This asymmetry paralyzes intelligent people. They stand on the sidelines holding cash, which is eroded daily by the silent tax of inflation, because the fear of making the wrong move outweighs the rational imperative to make any move at all. So our first order of business is a fundamental reframing. Investing is not about predicting the future. It is not about finding the next Amazon in a garage. It is certainly not about timing the market's chaotic undulations. For the vast majority of us, successful investing is the disciplined process of acquiring ownership in a broad collection of the world's most productive assets, and then allowing the inexorable force of global economic growth to work on your behalf. It's a shift from being a speculator to being an owner. Your primary financial goals, be it retirement, financial independence, or generational wealth transfer, are not achieved by outsmarting the market. They are achieved by harnessing it. The initial determination of your personal risk tolerance is the first step in this reframing, aligning your emotional capacity for volatility with a coherent, long-term strategy. To build this strategy, we must focus on the three pillars that truly matter, the architectural principles that dictate the overwhelming majority of your outcomes. These are asset allocation, diversification, and time. Everything else, the daily market news, the stock tips, the complex derivatives, is largely noise, a distraction from the foundational work. Let us begin with the most critical decision you will ever make as an investor. Your asset allocation? This is the strategic division of your portfolio across broad categories of assets, primarily equities or stocks, and fixed income or bonds. To underscore its importance, consider the landmark 1986 study by Brinson, Hood, and B. Bauer, published in the Financial Analyst Journal. Their research, which has been replicated and affirmed for decades, concluded that asset allocation policy is responsible for over 90% of the variation in a portfolio's quarterly returns. Let that sink in. The specific stocks you pick, the timing of your trades, all the things that occupy financial media headlines are a rounding error compared to the simple decision of how much you allocate to stocks versus bonds. Equities represent ownership in businesses. They offer the highest potential for long-term growth because you are participating in corporate profits, innovation, and economic expansion. However, they come with significant volatility. Fixed income or bonds represents a loan to a government or a corporation. In return for your loan, you receive periodic interest payments and the return of your principal at maturity. Bonds are the ballast of a portfolio. They provide stability and income, tending to zig when stocks zag, which dampens the portfolio's overall volatility. Your personal mix of these two is the primary determinant of your risk-return profile. A younger investor with distant financial goals might have a 90% equity, 10% bond allocation, while someone nearing retirement might have a 50-50 split. This is the cornerstone of portfolio management. From the macro level of asset allocation, we move to the micro level of diversification. Diversification is the only free lunch in finance, a concept at the heart of modern portfolio theory, developed by Nobel laureate Harry Markowitz. It is the principle of not putting all your eggs in one basket, but it's far more nuanced than that. True diversification means spreading your investments not just across different companies, but across different sectors, industries, geographic regions, and company sizes. Within your equity allocation, for example, you should own large-cap US companies, mid-cap international companies, small-cap emerging market companies, and everything in between. Why? Because the global economy is not a monolith. A downturn in the US tech sector might coincide with a boom in European industrials or Asian consumer goods. By owning a slice of everything, you smooth out the ride. You are systematically diluting idiosyncratic risk, the risk of any single company, industry, or country-specific event derailing your entire plan. You are capturing the broad upward trend of global capitalism itself. The final and perhaps most powerful pillar is time. Time is the catalyst that activates the engine of compound interest. Albert Einstein is often quoted as having called it the eighth wonder of the world, and for good reason. Compound interest is the process of your earnings generating their own earnings. It's a mathematical force of exponential growth. A simple illustration. If you invest $10,000 and earn a 7% average annual return, after 10 years you'll have nearly $20,000. But after 40 years, you won't have $80,000. You'll have nearly $150,000. The last decade of growth generates more wealth than the first three combined. This is why long-term investing is not a slogan. It is a mathematical imperative. The greatest advantage an investor has is not a high IQ or a sophisticated algorithm, but a long time horizon. Your job is to deploy capital and let the physics of compounding do the heavy lifting for decades. Now that we understand the architectural principles, we need to discuss the modern tools of execution. How do you, as a practical matter, achieve this broad global diversification in a simple, cost-effective way? The answer lies in two of the most significant financial innovations of the past 50 years, the index fund and the exchange-traded fund, or ETF. The philosophy behind these instruments was championed by John C. Bogle, the founder of Vanguard. His argument was revolutionary in its simplicity. Instead of paying expensive active managers to try, and usually fail, to pick winning stocks, why not just buy all the stocks in a market index like the S&P 500? This passive approach guarantees you will capture the market's return, and it does so at an incredibly low cost. The data overwhelmingly supports this thesis. S&P's own SPIVA scorecard, which stands for S&P Indices versus Active, consistently shows that over any 10 to 15 year period, more than 85% of active large-cap fund managers in the US fail to outperform their benchmark index, the S&P 500. By trying to be clever, they underperform a simple automated strategy. Professionals respect data, and the data here is unambiguous. Index funds and ETFs are the vehicles for this strategy. An S&P 500 index fund, for instance, holds shares in all 500 companies in the index, weighted by their market capitalization. When you buy a share of that fund, you instantly own a tiny diversified piece of the largest and most dynamic segment of the US economy. ETFs are functionally very similar, but trade on an exchange like an individual stock, offering intraday liquidity and often greater tax efficiency in taxable brokerage accounts. For most long-term investors, the choice between a traditional index fund and an ETF is less important than the choice to use one of them in the first place. These instruments are the embodiment of our strategy. They provide instant diversification across thousands of securities globally, all for expense ratios that are often less than 0.1%. With the right tools selected, we must address the strategy for deploying capital. The temptation is to wait for the right time to invest, for a market dip. This is market timing, and it is a fool's errand. A far more disciplined and behaviorally sound approach is dollar cost averaging. Dollar cost averaging, or DCA, is the practice of investing a fixed amount of money at regular intervals, regardless of market fluctuations. For example, investing $1,000 on the first of every month. When the market is high, your fixed investment buys fewer shares. When the market is low, the same fixed investment buys more shares. Over time, this mechanism automatically forces you to buy more when prices are cheap and less when they are expensive, lowering your average cost per share. More importantly, it removes emotion and guesswork from the equation. It automates discipline. While some academic studies, including a notable one from Vanguard, have shown that, historically, lump sum investing has outperformed DCA about 2/3 of the time, simply because markets tend to go up over time, this misses the crucial human element. Dollar cost averaging is superior from a behavioral finance perspective, because it mitigates the risk of regret. Investing a large lump sum right before a market crash can be psychologically devastating and may scare an investor out of the market for good. DCA is a robust, practical system for professionals who value process over prediction. Finally, we must calibrate this entire framework to your specific circumstances. Your asset allocation is not a static decision. It is a function of your personal risk tolerance and your specific financial goals. Risk tolerance is a composite of your financial ability to take risk and your emotional willingness to do so. Your ability is quantitative. Your age, your job security, your income stability, your existing net worth. Your willingness is qualitative. How would you react emotionally to seeing your portfolio decline by 30% in a year? A mismatch between these two can be disastrous. An individual with a high capacity for risk but a low emotional tolerance might panic and sell at the bottom of a market crash, locking in permanent losses. A frank self-assessment is critical to setting an asset allocation you can adhere to during periods of extreme market stress. This allocation must also be tethered to your financial goals. The timeline of your goal dictates the appropriate level of risk. Capital needed for a down payment on a house in 3 years has no place in the stock market. Its short time horizon cannot accommodate equity volatility.